Thank you so much, Anoka. That was a great intro. My name is Julie Bernhard. I'm the Director of Lead Management and Referrals for Nonprofits Insurance Alliance, or NIA. And I'm here with Robert Worden. He is with Bremer Insurance. They are one of the brokers that we work with here in Michigan, and we would like to thank you for taking time today to talk to us about this disturbing trend that we've been seeing in the marketplace. So let me give you a little bit of background on how this webinar came to be. So during a typical workday, I spend a significant portion of it talking on the phone with or answering emails for nonprofits. I work for a nonprofit insurance carrier, and I help nonprofits understand the process of getting insurance coverage. I refer them to brokers, and I provide them guidance on what to expect in the process. So last year, right after the pandemic hit, I really started seeing a trend in the phone calls and email inquiries I was getting. I mean, yes, a lot of nonprofits were pivoting to figure out how to keep serving their communities or even how to keep their doors open. But there was also a significant uptick in multi-million dollar organizations calling me because their policies were getting canceled and their broker could not find replacement coverage for them. One CEO I spoke with told me that his broker had tried 17 different companies and could not find a carrier to place their coverage with. So I've been given this webinar since last year to provide answers to nonprofits who are losing their coverage and have no idea why. We are still seeing nonprofits struggling to find and maintain affordable commercial insurance coverage. So we're not out of the woods yet, but knowledge is power. And so Robert and I will be taking you through all of these agenda items to empower you and your organization in making future insurance decisions. A good place to start is by taking a look at some of the market conditions that have led to the current insurance crisis facing nonprofit organizations. Robert?
Yeah, thank you, Julie. So throughout the years in insurance, it's a cyclical business. And we have, through those cycles, different types of market conditions that we call hard markets and soft markets. I've been in this business for 28 years, and I've seen a few of these cycles. However, we've really been through a relatively long, what we call soft market cycle. And during a soft market, that's where there's easier underwriting. Carriers are taking increased capacity, so they'll take increased coverages and that sort of thing. Typically, premiums tend to be lower, and sometimes you see reductions in premiums during a soft market. And carriers are open to taking on broader coverage and tougher to place risk. The last hard market that we were in really began after the financial crisis of 2009. And it lasted for a couple of years. And then around 2011, 2012, the market started to soften again. What I've seen throughout my career is that this cyclical nature runs in about 5 to 7 year trends. But the soft market that we've been in up until really last year was a relatively long soft market. That's all changed now as we've gone into what we in the insurance business call a hard market. Carriers are starting to think more about their underwriting, and they're getting tougher with their underwriting standards and characteristics. They're taking on less capacity as far as risk tolerance and market share. We're seeing premiums go up across the board, not just in the nonprofit sector, but we're also seeing premiums go up in for-profit business sector as well as the personal lines sector as well. And we're starting to see carriers start to restrict coverage, raise deductibles, and so forth. So we really are in a hard market cycle right now. We hope that it doesn't last long, but experience tells me that we've probably got a few years of trending in this hard market.
So you're probably thinking to yourself, well, how bad could this hard market be? So last year, we did a state of the market survey and we polled our brokers across the US. We had nearly 300 agents who responded. And as you can see, the results were not good. The general theme that these brokers were experiencing was in having difficulty in finding coverage and limits. In every class of nonprofit business in the survey, apart from 4, more brokers responded that they were finding it difficult to find adequate coverage and limits versus brokers who responded that they were not finding it difficult. But what about nonprofits who don't have any losses? They should be safe, right? Well, unfortunately, that's also not the case right now. Some commercial carriers are non-renewing nonprofits across the board. Nearly 56% of brokers in this survey said that carriers are non-renewing certain classes for businesses without regard to loss history. So, like Robert was talking about, the difference between the hard and soft markets, the difference really can be boiled down to capacity. In a hard market, there's reduced capacity. In a soft market, there's expanded capacity. Capacity is the largest amount of insurance or reinsurance available from a company or the market in general. So the price increase we're seeing for insurance premiums has been accompanied by equally significant decreases in capacity. And it's this capacity contraction that's come with increased deductibles, lower limits, and reduced coverage. So when you're thinking about capacity and the relationship between capacity and rate, we're essentially talking about supply and demand. Everything that we've been reading in the Wall Street Journal, the Insurance Journal, Insurance Business America, they all indicate that the market will continue to harden. And although nonprofits have been hit disproportionately hard, like Robert mentioned, the rest of the marketplace is now catching up. So increased premiums, capacity reduction, and strict underwriting is something that will be affecting most other sectors as well. Okay, so now that you have an overview of the market conditions that we're seeing, let's take a look at some of the factors that are driving these market conditions. So we've all seen it, more and more reports in the news shining a light on cases of sexual misconduct, sexual harassment, and sexual abuse of children. So let's focus on one nonprofit we're all familiar with, the Boy Scouts of America, because they were in the news quite a bit last year. As a reminder, the Boy Scouts of America filed for bankruptcy after facing hundreds of lawsuits from people who say that they were sexually abused as scouts. So for nonprofit organizations like yours, this increased public awareness is definitely a factor impacting the current market conditions. Any organization that provides services to youth, developmentally disabled individuals of any age, or senior citizens should consider some type of abuse or molestation coverage. But thanks to current market factors, what we're seeing right now is that the commercial insurance marketplace is generally backing away from offering coverage for certain exposures in organizations, like abuse or molestation coverage. And when it is available, it's often for a high premium and low limits. So there's no denying that the landscape has changed for the risk of sexual abuse and sexual harassment. What is important to note is that we're not seeing an increase in the frequency of sexual abuse claims, but the cost of resolving these claims has increased over time. And why is that? Well, one of the reasons has to do with statute reform. In state after state, lawmakers are now reconsidering laws that barred victims from suing. Last year, 30 states introduced statute of limitation reform, giving childhood sexual abuse victims decades more time to file civil lawsuits. This is opening up the possibility of new lawsuits for abuses that occurred decades ago. In today's climate, Organizations and their insurers may be responsible for potentially huge new claims they may not be prepared to cover. Insurers' actuaries will need to think about how they will be accounting for the financial consequences resulting from this legislation. So, this retroactive liability, which is occurring without having collected the premiums to pay on the claims, is really a recipe in the insurance world for fiscal instability. Robert?
And you couple that with a concept that we call social inflation. Social inflation, it's really one of the latest buzzwords in insurance, but it's used by insurers to describe the rising cost of insurance claims that result from things like increasing litigation, broader definitions of liability, more plaintiff-friendly legal decisions, and large compensatory jury awards. Now, while the core components driving social inflation have always been evident for some time, their impacts on the insurance industry have really started to come to a head just in the past couple of years. Probably one of the biggest drivers of social inflation is the general anti-corporate sentiment that exists. And that reaches back to the financial crisis of 2009. And it seems like a long time ago now in our rearview mirror, but it really created an environment that continues to gain momentum today. So since that time, there's been this greater division or separation of wealth, and there's just generally a feeling that someone needs to pay when there's some kind of damage or injury sustained, regardless of the negligence. Some of the factors that drive that social inflation is a concept called litigation financing. Litigation financing is where claimants are actually receiving help from outside investors to bring their cases to court. So these investors that will pay legal fees and expenses primarily towards the best and top-notch plaintiffs' attorneys in exchange for a stake in the potential awards and settlements. Additionally, the Plaintiffs Bar Association is very well organized, and they are very sophisticated and willing to invest in advertising, social media, technology, and expert resources to drive those damage awards higher. With that litigation financing, with the concept of social inflation, we're now starting to see a normalization of what we call nuclear verdicts. So across state courts, caps on punitive damages and damages for pain and suffering, they're being raised or they're being eliminated entirely. So this breaks the ceiling on what plaintiffs can ask for and what they will be awarded. Let's look at one case. Over the past several years, there have been numerous instances of trucking firms that have been involved in accidents or any type of risk that has commercial vehicle exposure. And in this particular case, where logical reason would not find a firm to be negligent, they were simply in the wrong place at the wrong time. So in May of 2018, a case was brought to a Texas state jury involving a Houston family in a tragic collision between their vehicle and a truck that was owned by Werner Enterprises. The jury found the trucking company responsible for an accident that occurred in 2014, which resulted in the death of a 7-year-old boy, the paralysis of a 12-year-old girl, and extensive brain damage to a third child. Tragic in any case, but this accident occurred during dangerous winter road conditions, which included freezing rain and subsequent black ice. The plaintiff's vehicle lost control on a divided highway, crossed the median, and crashed into the Werner-owned truck that was allegedly not equipped with the proper safety features. The jury awarded $90 million to the plaintiff. So in summary, when you take social inflation, and you take litigation financing, and then you take the risk of these nuclear verdicts, it's adversely impacting the capacity offered by carriers for general liability, auto liability, umbrella structures, and it's significantly increasing pricing. It's difficult for carriers to quantify or underwrite based upon societal attitudes regarding distribution of wealth or a perceived sense of justice. Excuse me. The verdicts being awarded are crippling business owners and insurance companies alike. So what are some of the factors that are driving, additional factors driving these market conditions? Well, one of the big ones is distracted driving. So whether an organization has scheduled vehicles on their policy, or whether you just have hired a non-owned auto on your policy, distracted driving, as we all know, has become a major issue in all of our communities. And accidents that are occurring from distracted driving are having higher plaintiff payouts involved with them, and we're seeing a much larger increased frequency in distracted driving. And it doesn't just have to be texting. And we also see accidents that occur from the use of a cell phone, even in a hands-free environment. What we've all seen it on the freeways of our community, people grooming themselves on the way to work, trying to use a navigation system, simply adjusting the radio or sound system in the vehicle, and then drowsy driving as well. So distracted driving, we're seeing that increased frequency, increased payout of claims that are associated with that distracted driving. And it's starting to impact the ability to get affordable auto insurance coverage for organizations.
So another major factor that we've seen impacting market conditions has been these catastrophic weather events. And it just feels like extreme weather events continue to intensify every year. And it's really leading insurers to have to develop new services and rating plans to keep their books of business more accurately priced for this risk. And as these risks increase for many carriers, their only sustainable option is to adjust their risk prices accordingly. So this is definitely something that is going to impact nonprofit organizations. I can tell you from experience, during 2018, NIAC, our California company, experienced its largest claim in its over 30-year history with the devastating Camp and Woolsey fires. The ultimate payout from these fires to our members was about $25 million. And because of excellent reinsurance partners, the ultimate cost to us was about $2 million. But for carriers who don't have appropriate reinsurance in place, a catastrophic weather event like that could easily have put them out of business.
So what are some of the coverages that are being affected with nonprofits? Those that we're seeing the most impact on, as Julie shared with you before, the improper sexual conduct coverage for those organizations that work with youth, developmentally disabled adults or seniors. We're also seeing directors and officers coverage being impacted. Where it used to be relatively easy to get a directors and officers policy and get that coverage, with the increased incidence of claims for harassment, discrimination, wrongful termination, or malfeasance by members of the board, we're starting to see a harder market occur for D&O coverage as well. And as Julie showed, the impact associated with wildfires, and particularly here in our area, here in Minnesota, we're starting to see just a huge impact on the property coverage associated with convective storms and hail damage that can occur. That's a major issue throughout the Midwest, and especially here in Minnesota. When we talk about nuclear verdicts, the umbrella coverage is severely impacted as well. And then probably one of the latest coverages being impacted, and it has the highest frequency of loss in 2020, is the cyber liability coverage. And while a lot of organizations may not have cyber coverage, it's definitely something that is at the forefront of all of our minds. Just look at what's happened in the news just in the last 3 weeks. We've had major cyber breaches on American infrastructure. Certainly, yes, they're large corporations and they're being impacted, but the pipeline hacking situation that shut down fuel distribution to the entire southeastern coast. And then recently here, just this week with the cyber hacking incident with JSP Meats, it's going to impact 20% of the total distribution of meat products throughout the United States. Those have significant impact, certainly on all of us and on our economy, but just think about what a cyber impact would have on your organization, even on a small scale, and how that would impact your organization. It's the number one frequency of loss that occurred in 2020 for all lines of insurance. So it is really becoming a factor. And because of that frequency of loss starting to increase, again, we're seeing it being much more difficult to obtain cyber coverage when you need it most.
So now you're probably asking yourself, well, what can I do? Our organization is facing rising insurance costs, there's reduced coverage in the marketplace, and it's just not conducive to driving competition. Well, positioning your agency for the best possible renewal outcome is one way to improve the outlook for your organization.
So how do you navigate that renewal? Well, the best advice that I can give you is start early, start very early, because that allows us as an agency or any broker that you may use to be able to paint the best picture for your organization. And by doing so, giving us time to really find out what the real needs and concerns of your organization are. But also our role as a broker is to go to our carrier partners like Nonprofits Insurance Alliance, talk to the underwriters, and really create a picture of why they should insure your organization or continue to insure your organization if they're looking to take some type of underwriting action. So we encourage all of our clients, start early with your renewal. We like to reach out to our clients 60 to 90 days in advance to start that renewal process to make sure that we can gather all of the necessary information and provide the best organized and the best story to share with the underwriters. So oftentimes you've got to gather financials. There may be things that you'll want to gather, such as your safety programs and loss control programs that you have in place. So if you have started those programs, or if your broker suggests that you add some type of safety program or loss control program, it allows us to have the opportunity to help you get that implemented and in place so that then we can share that with the underwriters to, again, create the best picture to get you the best coverage and the best pricing for your organization. I think, Julie, we covered that, so we could probably move on next.
Okay. Yeah, and one thing that Robert and I wanted to touch on is, there's this common misconception out there that getting quotes from several different brokers is going to enable your organization to get the lowest price possible. And, it's just not true. Ultimately, it's going to be a huge waste of time and energy for the nonprofit and all of the brokers that are involved. So brokers are independent agents. They do not work for insurance companies. Brokers can provide quotes from many different insurance companies. So generally, brokers shop for quotes in their given fields of expertise. Nonprofit insurance is a really specific niche of the marketplace, and it's just not something that all brokers handle. The brokers that we use as referrals deal primarily just with nonprofits. They're very familiar with the marketplace for nonprofits. They understand the types of coverages that they need, and they can provide them with the level of service that they deserve. Some nonprofits, they still think that they can get a better deal by having two brokers get a quote from the same insurance carrier. So again, one broker can get you quotes from multiple insurance carriers. But usually insurance carriers are not going to provide quotes to different insurance brokers for the exact same nonprofit. When you think about it, presented with the same information on the application for insurance, the price of insurance shouldn't vary depending on which broker requested the quote. So there is no reason to have multiple brokers. There's going to be no difference in the premium for the exact same coverage from the same insurance company between different brokers. The only difference is going to be in the commission that's going to be paid to these brokers by different insurance companies. Because brokers are working with you and not the insurance companies, they're able to compare the coverage of various insurers to get you the best rates and conditions in the market. Brokers can provide your organization with the most unbiased, cost-effective, and strongest policy recommendations. The benefits of working with brokers goes a lot deeper than what you see just on the surface level. By working with brokers, your organization is going to be receiving more personalized service. You're going to be getting assistance with your loss control and risk management. You can have help in reviewing contracts. You can get advice on insurance needs on a regular basis. And your insurance broker can also help you report claims or potential claims to the appropriate insurance carrier. Like I said, insurance for nonprofits is a very specific niche of the marketplace. And brokers working with these organizations, they have to be able to assist them in understanding and evaluating the specialty coverages they require. So please keep in mind, not all brokers are familiar with working with nonprofits. So it's really important that your broker has a book of nonprofit business. And also keep in mind, brokers specialize in lots of different things. So you need to make sure that the person you're working with at your brokerage is someone who deals with nonprofits. It's just so important for that broker to understand your organization's operations and then be able to advocate to the insurance carriers on behalf of your organization. As a nonprofit, risk management should definitely be a consideration when you're choosing not only your broker, but also your insurance carrier. The value of your insurance needs to include risk management and loss control resources. So your broker is someone that can assist your organization with loss control and risk management. They can be willing to take time to learn about your agency's operations and provide thoughtful advice and counsel about your agency's exposures and insurance needs. Consequently, your insurance carrier should also provide services, training, and consulting assistance that's going to help you prevent claims and mitigate exposures that are disruptive to the critical services that your organization is providing. Risk management is a culture that should start with your broker and your insurance carrier and then continue throughout your organization. So speaking of risk management, for the purposes of this presentation, we'd like to focus on risk management best practices concerning prevention of abuse and molestation and sexual harassment. So, like we've indicated, these claims have had huge impacts on coverages and they're driving current market conditions. Risk management is a cornerstone of accountability in any organization. And programs such as volunteer management, safety procedures, and staff training help your organization to avoid injury. And you should be able to find most of these free of charge through your carrier.
So when you're looking to develop a sexual abuse and prevention program within your organization, organizations really have to find a balance between the need to keep youth safe with the need to nurture and care for them. In some cases of sexual abuse or exploitation, it's the inappropriate behavior that appears or comes first. And it may not be illegal. Paid and volunteer staff need to understand that the supervision of children and teens never includes sexual contact, sexual behavior, sexual flirting, or innuendo. It's just period, it cannot happen. So your organization's mission and activities have to determine guidelines based upon the interactions between adults and youth individuals. So for example, organizations that promote one-on-one activities between adults and youth may need different interaction guidelines than programs built around group activities. You should develop interaction policies before situations arise, and those policies need to be tailored to the developmental age and maturity of the youth, of your employees and volunteers. Strategies also need to match the cultural context of those that you're serving. So every nonprofit serving children and teens should adapt policies that limit opportunities for abuse to occur and ensure the prompt detection of that abuse. Here's an example that occurred at one of our nonprofits. The organization was operating a residential care facility for teenage girls in which a young male staff member impregnated one of the female residents. He had been signing the girl out and her roommate for off-campus outings. The investigation revealed that the organization's operating procedures permitted staff members of different sex to take residents away from the facility without a same-sex staff member to accompany them. The organization has since modified its practices, but even the most conscientious of organizations are subject to claims for improper sexual conduct. So making sure that you have solid policies and procedures in place and insisting that those policies are followed can dramatically reduce the potential for these claims. It'll never guarantee that such a claim won't happen, but hopefully it'll reduce those. So there are no foolproof methods to screening individuals who may have the potential for abusing children. But organizations providing services to children, they do have a duty to take reasonable steps to screen applicants. And a failure to exercise due diligence in the selection of employees and volunteers can definitely be considered negligent if abuse results. Before you start your screening, develop criteria that define how screening information will be used to determine an applicant's suitability, including who has the final say on that applicant. Your policies and procedures for screening and selection should be consistent and systematic. Include a sequence for the various steps of the process and a timeline. Be sure your policies don't violate federal, state, or local laws prohibiting discrimination in the workplace. A screening checklist, definitely something that your insurance carrier should be able to provide to you free of charge, or help you create with their loss control expert. Employment and volunteer screenings for positions of trust are highly recommended to reduce risk, provide security, and safeguard your mission. Your carrier should also be able to offer you reduced rates for these background check services, for drug screening, and for motor vehicle record checks to assist you in your hiring decisions. So when it comes to monitoring behavior, unlike other child abuse prevention strategies, adequate monitoring is harder to determine. Here's a perfect example of monitoring that occurred with one of our nonprofit insureds. This nonprofit operates residential group homes for teens. They require that at least 2 staff members are always on duty, including the overnight hours. Bed checks are required every half hour and are conducted. However, at one of the houses, a male staff member did most of the nightly checks, while his coworker did the daily paperwork in the office. The staff pairings varied, but whenever this particular worker was on at night, he always volunteered to do the bed checks. It wasn't until a coworker reported the male staff member's consistent volunteering to do bed checks that the organization began an investigation and uncovered inappropriate actions. It was later determined that the male staff person was involved in an ongoing sexual relationship with one of the clients. Several clients and the employee conspired together to keep the relationship secret. The investigation revealed that all background checks, including fingerprint checks, were clear, but the staff was trained to report any situations in which they were uncomfortable with either the behavior of another staff person or the behavior of a client. It was the fact that this person consistently volunteered to do these bed checks that finally alerted the organization to the improper sexual conduct. Additionally, environmental strategies come into play. And these environmental strategies, they vary depending upon the organization. So an organization with a physical site, like a nursery school or a youth club, will have different strategies than one with multiple sites or for activities, or one with an undefined space, such as a mentoring organization. So you should consider the risk of the environment regardless of your organization's physical space, and use those strategies to ensure youth and employees or their volunteers can be monitored in all situations. Your child sexual abuse prevention efforts aim to prevent abuse from ever occurring. However, your organization needs to have communicated clearly what it and its employees and volunteers should do if policies are violated or if sexual abuse occurs. Define inappropriate and appropriate strategies for the organization. Clarify that Child Protective Services, law enforcement, and child advocacy centers will investigate allegations or suspicions. Investigation is not the role of an employee or volunteer. Your policy should clearly delineate what behaviors the organization will respond to internally and what behaviors require reporting to the appropriate authorities. Act on infractions of your policy immediately. Your organization should have clear guidelines about how and when to report allegations and suspicions to authorities. And be sure that your procedure includes notification to your insurance broker immediately at the time that the incident is discovered.
Yeah, we also want to touch on sexual harassment because, it affects more than just the employees involved. It really can affect your entire organization. Besides causing emotional duress and decreased performance, lawsuits resulting from sexual harassment are stressful and expensive. Sexual harassment prevention training can help build awareness as well as provide guidelines on what to do when encountering these situations. Not only is it the right business decision, but many states require companies to offer sexual harassment training for employees. Right now, there's no specific sexual harassment training requirements for the state of Minnesota. However, sexual harassment prevention training is still recommended for employees if your organization meets any of the following criteria. You have employees working in states other than Minnesota. You're an educational institution that worries about meeting Title IX training requirements. You've had problems with sexual harassment or other types of harassment in your organization in the past, or you wish to mitigate potential liability for sexual harassment in your organization. To assist our members in compliance with mandated training requirements, we provide free online training for employees and or volunteers with supervisory responsibilities. And if the law should change, your carrier should also provide you with free sexual harassment prevention training to meet any state requirements. So whether you're talking about risk management best practices concerning prevention of abuse and molestation or sexual harassment prevention, ongoing accountability is an essential hallmark of an organization who takes these trainings seriously. Accountability requires organizations to have systems to document consistent implementation of policies and procedures and evaluations of their impact. Accountability allows organizations to learn from adverse incidents, respond appropriately to them, and reduce their future likelihood. So the good news is, if the standard commercial insurance marketplace is unwilling or unable to offer your organization coverage, there are alternatives to the traditional marketplace that are becoming more and more popular during this insurance crisis. The insurance marketplace has evolved significantly over the past several decades. Organizations today have access to many forms of risk transfer beyond the purchase of traditional insurance. For example, the alternative risk transfer. It's a market that allows companies to purchase coverage and transfer risk without having to use traditional commercial insurance. Some of you are familiar with self-insurance, which is a form of alternative risk transfer. It's when an entity chooses to fund their own losses rather than pay insurance premiums to a third party. A captive insurance company is an insurance company that's set up and wholly owned by a non-insurance company to act as a direct insurer or reinsurer for the parent company and its subsidiaries. The primary purpose of a captive is to reduce the company's total cost of risk. These are just some of the alternative offerings that your broker can provide you with more information on. But for the purposes of this presentation, let's take a closer look at RRGs. Risk retention groups, or RRGs, are a crucial and highly successful form of insurance for many business entities. RRGs pool their similar risk exposures to collectively self-insure. They're effectively owned by their members. RRGs provide an innovative solution for similar entities to insure themselves. We've seen RRGs formed for groups of hospitals, attorneys, financial institutions, and yes, even nonprofits. In 2020, there were over 200 RRGs representing total gross premium of $5.3 billion. RRGs also have a great deal of financial stability, and they remain committed to maintaining adequate capital to handle losses. There's a ton of benefits of working with an RRG. RRGs can develop highly specialized underwriting and claims handling because they focus on only one type of business. And that's why they're so innovative and successful in the marketplace. They're also increasingly important to the way businesses protect themselves. It's also important to keep in mind that all RRGs are subject to state requirements for minimum capital and surplus. So they're uniformly regulated in the same way as traditional insurance companies. But because of their specialization in only one field, they tend to be very competitive and innovative in the insurance marketplace. Nonprofits Insurance Alliance is an example of a risk retention group. NIA began as a direct result of the liability insurance crisis of the mid 1980s, when insurance companies were refusing to offer affordable liability insurance to nonprofits, believing them to be high risk. Well, that was over 30 years ago. And through our financial strength, benefits for members, and partnerships, NIA continues to ensure that nonprofits have their own insurance carrier that operates so members can continue their important services. So the insurance crisis we're facing right now has hit nonprofit organizations like yours disproportionately compared to other business sectors. But like we discussed, there's things that you can do. Robert talked about when your renewal comes up, how to position your agency for the best possible renewal outcome. We also discussed some risk management best practices that your organization can follow. NIA is also working hard to make sure that nonprofits have affordable and reliable options for insurance long into the future. And to do that, we need Congress to allow risk retention groups like NIA to write property insurance for our members, as well as the liability insurance that we already provide. HR 4523 is the Nonprofit Property Protection Act, and it's a bill that was introduced to Congress to help us do just that. Since all politics is local, members of Congress need to hear from you. Please tell your member of Congress to support this bill. And most importantly, I really do believe that it all starts with your broker. Providing service to nonprofit organizations is a very specific niche of the marketplace. So you should make sure that this is something that your broker regularly handles. And if they don't, your broker might not be able to assist an organization like yours. They're not going to have access to the market, and they're not going to be able to provide you with the help that you're looking for. The assistance is out there. You just need to be talking to the right people. So we'd like to thank your group today for taking time with us to learn more about what is happening in the insurance marketplace. And we hope that this information will empower you in your future insurance decisions.
Thank you so much, Julie and Robert. Just wanted to say, if you have any questions, please feel free to use the Q&A function that is at the bottom of your screen. Or I don't know if you can unmute yourself here. So maybe just using the Q&A screen. Just to get us started, we had some questions at the prior to the webinar today on what nonprofits should actually be paying for and what type of coverages do they need. You covered some of it, but just wanted to see if you, Robert or Julie, have answers to that.
Well, I can certainly chime in with, it depends. And I know that's not a great answer to hear, but it really depends upon, what the mission of the organization is and what the services that they're providing are, because with insurance, there's classification codes that are used from an underwriting standpoint for every type of organization. So, social services, we tend to see sometimes paying higher premiums than maybe just like a community civic organization. It also depends on what type of coverage. So to answer the second part, what type of coverages should an organization have? Well, that's very specific to the organization. So that's why we like to definitely take a look at each organization independently and make recommendations about really what coverages they should have based upon their needs and the services that they're providing. It can vary all the way from general liability, property coverage, directors and officers liability, the ancillary coverages that come with that, from employment practices to improper sexual conduct, commercial auto coverage, cyber liability coverage. So a whole realm of coverages that are available to organizations. but it really is specific to each organization. And it's hard to say, well, what should they be paying? Because those are all based upon one, what they're doing. And then with some coverages like directors and officers and cyber and so forth, it's based upon the size of the organization. And when we talk about size, it's typically has to do with what the annual revenues and what the total assets of the organization are.
Yeah, so thank you, Robert, for that. That's one of the most common questions I get asked about is about coverage and what nonprofits need. And no two nonprofits are alike. They're all very unique animals, which is why we do take so much time and consideration in underwriting each individual nonprofit. I could say the core coverage that a lot of nonprofits carry would be the general liability, and that's what's going to provide coverage for the nonprofit itself, for activities and events that it may have, and for volunteers. But from there, that's really a great conversation to have with a broker. The broker needs to go in and they need to learn about everything that your organization does. And at that point, they can help advise you as to appropriate coverages that your organization should consider. And then they can go out in the marketplace and get you quotes for those coverages.
Should know after a year and a half that unmuting. Anybody else have any other questions you would like to ask Robert or Julie? Well, hearing none, why don't we give back 5 minutes of your time? I just have a last few minutes things to say, which is essentially thank you to Robert and Julie for this very informative session, and for all of you for joining us today. And again, this is a reminder, this webinar was recorded, and I will be posting a link to that on our social media, Facebook or Twitter tomorrow, or sometime this week. And that's it. So have a great rest of your day, and thank you so much. Enjoy this beautiful weather. Thanks for joining us.
Thank you.
Thank you.